get going here. Today is Monday, March 9th, 2015. This is your daily Forex trading strategy session brought to you by tradersway.com. My name is McDonald. I'm the Chief FX Market Strategist. We can cover Forex, energies, metals, indices, even some binary strategies, if you will. Currently, we have a strong pound, strong euro. Well, you know, it was strong, but it's actually neutral right now. Neutral Swiss franc, weak Japanese yen, weak US dollar, neutral Aussie, strong CAD, neutral Kiwi. So the biggest winners are basically what? Pound and CAD. Biggest losers, yen and dollar. Maybe pair them up, huh? As far as news since non-farm payrolls on Friday, which was a doozy, some things have occurred. Chinese export data was reported. Another huge surge. It's very interesting. Exports are up, which is probably a sign of a decent U.S. economy. And imports are down, so therefore the net result is quite dramatic. So, you know, falling net imports out of China just means the Chinese economy is doing poor, and yet the U.S. economy is doing pretty good. So, anyways, record trade surplus. Japan is technically out of recession again. Yay! 1, 2, you rock! Yeah, good job, Japan. They have a GDP of 0.4%. Yeah, 0.4%. Well, hey, at least it's not negative 0.4%, right? Yeah, good job. Wow. Amazing, isn't it? Trillions of yen, and that's all you get? Well, that's why doing quantitative easing and jacking up taxes at the same time is just a bad idea. Welcome to Economics 101. ECB starts quantitative easing today. Nice. Very nice. Good job. Yeah. Good luck with that whole economy thing. But, you know, yeah, so, yeah, about time, right? So maybe it's the beginning of the end of the horrible European economy, right? But guess what? Let's throw some fuel on the fire. The European finance ministers are going to get together and reject Greece. So that could be fun. I still think the ECB should trade Greece for the Ukraine. I still think that's a pretty good idea. Let's get the show on the road, huh? Now, remember, trading Forex is risky, especially with leverage, and not appropriate for everyone. Your past performance, good or bad, never predicts future results. So always stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Okay? See? All right, so it's Monday. Why don't we plan out our trading week? Right? Let's plan it out. You got to stand for something or you fall for anything. So you tell me, what do you want to do first? Commitment of traders report to find out where the large positions in the market are? Or would you like to start with the calendar and look at economic event risk? This is where you actually type something into the little chat room. Calendar report, calendar COT, either. All right. I have the calendar open, so why don't we do that one? Boop. All right. Lots of stuff going on. I don't think it'll be as crazy of a week. We've had some very packed, eventful weeks, as of late. Okay. Oops. All right. So coming up, we have some business confidence out of Australia. Not that important. Really, it came down to the trade balance. The Chinese trade balance, I think, was probably much more important. Um, and we did learn a lot, right? From deduction. How do you get rid of trade surplus? You buy a lot of stuff and you sell hardly anything, or the other way around. And that's the Chinese scenario where they sold lots and lots of stuff, but they bought hardly anything. So that just shows signs of weakness in their own economy. Plus, we know adjusting the RRR, which they did 2 weeks ago, and then last week they changed interest rates. Now, changing interest rates changes the money supply like a bazooka. Remember Big Ben, Ben's bazooka? Um, the Chinese recently used a bazooka on the money supply to create consumption. But just a few days before that, they used a nuclear bomb, so to speak. They adjusted the reserve requirement ratio for their entire banking system. And that's such a big deal to us, anyways. The United States last changed the RRR in 1992. And what's interesting is Chinese central bank changes RRR, excuse me, all the time. Now, it's because, the banks are really belong to the states, so I guess it's easy. If you did that, if the Fed came out and adjusted the RRR, all hell would break loose in the global financial economy because the banking system and such is complicated enough where you can't change RRR without freaking everybody out. That little thing, right? So it's interesting. They do it all the time in China. But so, anyways, we did learn that the Chinese economy is not doing so well based on um, the fact that they're not spending any money. Interesting. We will find out a little bit more about their inflation levels and then industrial production. So, how about this? Let me boil this down to something pretty simple. You should trade the Asian session coming up, the coming up Asian session, and you should probably trade the Aussie dollar. Sound good? Chinese industrial production, Chinese inflation data. We just did Chinese trade balance and some Australian business confidence. Put that all together, you should probably trade the Australian dollar. And in particular, if it's late for you, the Asian session, like let's say you're in Europe and it's just, it's a tough one to make, that would be one worthy of your effort, right? So you got this one, and then the following, right? So we got the Asian session coming up is this Aussie business confidence and Chinese CPI. Then the following one is the industrial production, right? And RB and Z interest rate decision. So you got back to back. You get it? So basically Tuesday and Wednesday Asia, you should be on board for that. That's going to be really good. Do you think the New Zealand interest rate decision is important to currency trading? You think that one's a good one to? Yeah, man. Yeah. And in fact, they're the only major central bank out of the G8 that has high interest rates. Right? So what if they want to cut interest rates? That's going to change everything, right? So we got to pay attention to that. The economy isn't strong, so we got to pay attention, see what's going on. Okay, we can learn a lot from that information. Okay. And then now Wednesday comes along and you should trade Australian dollar again. What's the theme so far? Yeah, Monday you should be trading the Aussie. Tuesday you should be trading the Aussie. Wednesday you should be trading the Aussie. And then Thursday you should be trading the Aussie. Maybe you should write that one down, right? Australian dollar. That's not an Australian accent. All right. So anyway, so that's a doozy, right? Just back to back to back to back to back to back to back. All right. Retail sales out of the U.S. Okay, fine. That's volatile. The only sort of news to use on that type of data is that Boston, for example, has had more snow than Alaska this year. It might be, I think, records. I attend classes in a university in Boston, and in the first 4 class meetings, Mondays were canceled because it snowed a weekend to the point where snow was like over the top of ours. So all classes had to be done online because the campus was closed. So what do you do when you're taking a class and you've missed 1 month of classes, the first month of classes? Thank goodness for that whole internet thing. So what I'm thinking is things like retail sales are going to be impacted by such weather. Just the Northeast. I mean, even just taking Massachusetts offline might impact some of this data. I'm not sure how much it snowed in other places. Let's say in the Midwest. Did Chicago get a lot of snow? I don't know. It just seems Boston, 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 Boston. So anyways, retail sales probably will be affected. Put it this way, I don't expect a ripper good number. Do I expect a ripper bad number? No, but I think the risk is to the downside due to weather. Okay. Weekly unemployment claims. Okay. This has been trending up though, hasn't it, recently? This is not going to give us a trend, huh? Yeah, so that one I'm a little interested in. I'd like to see a trend line on that. Yeah, it should be going down based on non-farm payrolls, right? But remember, non-farm payrolls is a mathematical guess. It's fuzzy logic. It's, mathematical engineering. So unemployment claims are people filing for unemployment. That's that. The non-farm payrolls, which we just had, which showed a very, very positive uptrend as far as jobs being added. This would be jobs being lost, right? But what they're actually doing is the non-farm payrolls is actually if you went to the Bureau of you said, give me the NFP numbers, they're like, well, there isn't actually an NFP report. Isn't that interesting? So there's two things, the establishment survey, they can give you that, and they can give you the household survey. They can give you that. Two different surveys, two different methodologies completely. Establishment surveys for businesses, they knock on the door of businesses and they say, give us your payroll stubs. And they count that. Fine. But do they have the time and the wherewithal to grab those payroll stubs from every business in America? No, probably not. So they go out to a few thousand and say, this represents all of America. Yeah, sure it does. And then the next one is a household survey where they go door to door and actually they call you on the phone, right? Ring, ring. McDonald residence. Yes, this is the Bureau of Labor Statistics. Does anyone in this household, get a paycheck? No. I don't get a paycheck. My wife doesn't get a paycheck. Okay, next. Then they call, my neighbor. Hello, this is the Bureau of Labor Statistics. Does anybody in this household get a paycheck? Yes, I get a paycheck and my wife has 4 jobs. So 2 people? Yes, well, I have a full-time job and my wife is underemployed because she has 2 PhDs, but she has 4 jobs. Oh, so 2 people get paychecks. You see the flaw there? Like, isn't that important information to know that one person is underemployed? They have 4 part-time jobs. Like, yeah, we don't care about that. So yeah, okay, fine. So they just throw all these numbers in a basket, right? Now, I might own a small business, but I don't get a paycheck. I don't get a pay stub, right? I get owner equity. Or profit and loss from trading, but I don't, and therefore there's distributions, but I don't get a paycheck, right? So they wouldn't count that. So anyway, so long story short, they take all this fuzzy logic because obviously they're not going to interview or call every household in America, right? So they do a random sampling of a group of various groups of people, and then do some sort of weird mathematical, witches brewing, and they come up with a number. Well, I'm concerned about it because a factual number based on how many people are asking for unemployment, right? That's been going up for a while, hasn't it? But we're not getting that in NFP. But even that is a different methodology, isn't it? What you could probably do is create an exponential moving average based on weekly candles. Wouldn't that be interesting for unemployment claims? You create a chart and then overlay an exponential moving average. Okay. So anyways, and then what? Canadian unemployment. What was that rate, E? PPI, which is inflation for a basket of how would you say, resources used to make things. It's on the producer level, not the consumer level. Okay. The interesting thing about PPI, the reason we use PPI, how about that? The reason we use PPI is to predict consumer inflation, and you're going to see PPI well before CPI. Right? And then University of Michigan, consumer sentiment, whatever. Okay, so there's the week. I think it's going to be an interesting week, right? Aussie, 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 Aussie. And some CAD at the end of the week. right? Maybe a cooling off period for the US dollar? No, maybe. But, I'd like to see the trend continue, right? As far as dollar strength. I mean, we've been doing the dollar strength thing for a very, very long time now. And I don't see any reason to stop. Right? Oh, great. So the next one is the Commitment of Traders report. And these are large positions in the marketplace. Is it consumer sentiment? Right? Is it a survey of hedge fund managers? Tell me, Mr. Hedge Fund Manager, how do you feel about the market? I feel great. No, it's a measurement of money put into the market. Right? That's the part I like. I'm not a big fan of sentiment. So these are positions that are large enough that they're required by the CFTC, the Commodities Futures Trading Commission, a la the US government. They're required to report their positions because they're so big. So Wyatt's trading might be in here. Hey, Wyatt? Yeah, 100 million here, 100 million there. Pretty soon it adds up to real money, huh? Yeah, so they're very large positions, and they're non-hedging. Well, who would hedge? Well, that would be like IBM and Coca-Cola and Apple computers that are hedging foreign exchange risk. Well, these are non-hedging. So, right? So if you're a hedger and you're a market participant in foreign currency, right? You tell the CFTC, we're hedgers. And this is important for things like taxes and stuff, right? So you say, no. We might make money accidentally in the Forex market or lose money accidentally in the Forex market. But it's all about hedging. We're all just trying to hedge, lock in today's price at a future date. Okay? So those get reported, right? And then you could look at non-hedging positions. What are they trying to do if they're not hedging? Let's assume that they're trying to make money. And then you could look at all the rest of the open positions and find out, okay, so you got large hedging positions, you have large non-hedging positions, and then you take the total volume, subtract those things out, and then you get small, non-sophisticated investors, right? Dumb money. So it's all through process of extrapolation. So anyways, non-hedging. These guys are big players, and they're trying to make money. And they're putting real money on the line, not sentiment. So starting with euro now, very, very, very little change. Okay. I would say essentially the same amount of people long. And, and just a little less people short. What accounts for this? This data is from Tuesday. Okay. And it's now Monday. And we know that Wednesday, Thursday, Friday, right? The Euro USD has fallen. It's just not in this data yet. But there's very little change in the data from the week before, right? Almost no change in people being long euro. Here, there's slightly less people short euro. So what was our plan last Monday? We looked at the commitment of traders report and just said, well, nobody is going long even though the euro is slightly stronger than it had been. There's just less people short. So we called that profit taking. And that we believed the trend for the Euro USD, which is down, would continue, and that our role should be to look for selling at resistance. DeBeasta, that's what I'm saying. Non-farm payrolls data is not reflected in this. Okay? But we got to go back to a week ago, because who cares about this now? This is nothing. Okay? Last week we had the same, essentially the same report here, and we said because of this data we're still bears on the Euro USD, and that we should be looking for resistance to sell high. And do you remember we had Euro USD in a range, and we were looking to sell, and then I think it did something like that. We stayed firm commitment to the trend because of this data, because there was no reason to bet against the trend. And because of this data, I think we made an intelligent decision to stay a bear, and you should have caught it. Okay? So all we can do now is say, well, by tracking this data, our confidence stayed firm in our trend because of factual information. And we know the future. We know what happens here. It's not on the chart yet, but we know we're right. But how do you stay confident in that? How do you know it's not reversing? Well, in this case, we looked at the commitment of traders report last Monday, and it said nobody's buying euro. There's just less people short at the moment, but when they get an opportunity like selling it at resistance, they'll get back in, because the only reason they got out was to make money. So they need money doing this way. They would like to continue make money doing this, right? So anyways, good. Okay. Remember, confidence is very important in Forex. So if you can confirm your bias based on factual information, in this case, you could say to yourself, well, I did my research and I can see that large speculative institutional investors like hedge fund managers are still heavily net short, and I believe they will continue to add to their net short position. Versus, I feel the euro is going to continue to fall. Right? Isn't it nice to base your trading strategies on fact, and that you're doing what large hedge fund managers are doing? You're just allowing them to move the market for you, and you take along. Right? You let the 800-pound gorillas climb up the banana tree for you. All you have to do is pick up the bananas they drop. You're not going to fight the 800-pound gorilla, but why not let them do all the work? All right, British pound. Okay. Small increase in short. Small decrease in long. Increase in shorts, decrease in longs. That's not good, right? That would put pound dollar short. I'm hoping for the pound to make a recovery. I'd like to start buying British pound. So we'll see. We might have to be patient on that one. So that's a double whammy, right? That means pound dollar down. So I'd like to see a different trend, really. I'd like to see the gray line go up, and I'd like to see the yellow and golden line come down. I guess gold and silver, right? I'd like the gold line to come down, silver line to go up. And Pete's why? Well, I don't know why. I can't tell you why. Oh, why do I want it to go up? You know, there's a couple of things. One, fundamentally, there is signs that their economy is improving. Two, the members of the ECB are, some of them are changing their sentiment and their votes. So that's interesting. We see some inflation at the wage level, you know, and then I guess number four, Carney has come out and said he still believes in, you know, inflation coming into the UK economy, but their current deflationary situation is primarily created by the crash in oil prices. Okay. So I like to think ahead and be ready. So I'm paying attention to the clues. And then lastly, technically, we're at a big double bottom on long-term charts, like even weekly charts would give you a double bottom. So, you know, I'm ready to be ready, you know. Okay. And you probably saw the British pound skyrocket today and Friday. So it just happens to be ready. Remind me to go over the British pound if we can get time today, because we have a big setup based on the daily chart and stuff. You should already have done that work, right? You should have already logged in, analyzed your pound charts by now, set up a bias for the week. Okay. Japanese yen. Long prices, or sorry, long positions. Slight increase. Short positions, I would say bigger increase. Net result, a drop. First drop in a while. You notice that? Since the middle of January. So in the middle of March, for the first time in the whole quarter, we're getting a net short, an increase in net shorts. Is it possible that is being influenced by the end of the fiscal year? And that any money that needs to be moved has possibly already been moved? Yeah, well, that's what we've been talking about. week after week after week after week after week. In fact, if you and I were hanging out together in October when we were shorting the Japanese yen like crazy, we knew, or we had discussed logically, that at the end of the year and the beginning of 2015, we should expect an increase in yen strength, right? We were talking 3 months ahead that we were going to short the Japanese yen for 90 days and then turn around and buy it for for another at least 60, maybe 90 days. And that if things go right, we will then continue to sell Japanese yen for 90 days, maybe a lot longer. Isn't that interesting? Can anybody confirm that we had that type of conversation maybe 25 times? That we typically would think 3 months in advance? That last summer nothing was happening, so I said get ready, the yen's going to weaken. We're going to sell it till Christmas. Then we did, and then while we were doing that, we were preparing for January, February, March for yen strength. And then ideally, since they're not raising taxes this year, that maybe the yen weakens again. Yeah, maybe through summer, but certainly in the second half, that we should be looking at, 135, 140, right? Yeah, Ron, or like 50 times, Ron says. So that all I'm saying is that if you understand, let's say the economics or the business side of the market, some of these things are not sort of voodoo magic, are they? That you could prepare and say, well, this is likely to happen for this logical reason, therefore I can be ready. Okay? Cool. So that drop from 125 to 115 should have been expected. And then the move from 115, and now we're on our way back to 125, should be expected. And then I think the fundamentals are still the same. So maybe just maybe it'll continue. Fine, good. I guess one thing we should talk about if we're talking about the yen right now is that technically they're out of recession again, right? I talked about it earlier. So we do need to keep our eyes on the prize and make sure the Bank of Japan stays accommodative, meaning that they continue to weaken the Japanese yen to create inflation. If they start talking about the end of, of their current policies, that could then bring yen strength back. I think what we need is some inflation out of there. And we've talked about this for many months. But we need negative real interest rates in Japan. And to get that, we need inflation. But oil prices have killed inflation. And in particular, inflation in Japan, because Japan imports its energy. So they import oil. In fact, there was a time recently, in just the last year or two, where Japan essentially spent every penny it had on oil. Amazing. That's why they have nuclear power plants. Unfortunately, they also have earthquakes. So anyways, with oil prices coming down, it's very dramatic for a lot of countries. It's quite dramatic for Japan. So yes, they're happy to pay, you know, 45 or $50 a barrel for oil because they're going to buy the oil no matter what the price is. So, you know, hey, 50 is better than 100, right? But the problem is that keeps inflation low, and when inflation low, it's hard to create inflation, right? To increase inflation, and therefore there's not enough incentive at the moment to move your money out of Japan. If you're an institutional investor that has a 10, 20, 30-year horizon as far as risk, inflationary risk, if inflation was higher, let's say 3%, and your JGB, your Japanese government bond, paying you 1.5%, then you're guaranteed to lose in real terms 1.5%. That's dramatic for someone that has $100 billion. So, you know, if they can create the inflation they're trying to create, once they get there and real interest rates turn negative, then these large risk-averse institutional investors like pension funds will start to divest. And you may have heard from me in the past that I try to track Japanese bond fund flows. If you go to the Ministry of Finance for Japan, they actually produce an Excel spreadsheet every week that shows Japanese banks buying and selling bonds, both JGBs and foreign bonds. The trick, though, is everything's in Japanese. But hey, man, you got to have some alpha. So I like to watch that from time to time. And some other things. But what we would like to see, obviously, is institutional investors buying foreign bonds that pay a higher yield. Okay? Think about it. Japan, if you're a Japanese bond investor, or like a pension fund, you're risk averse, you're not buying bonds to make money per se. What are you trying to do? Hedge inflation. Right? That's all you really care about. So if you get paid 1% on your bond every year, guaranteed, so it's risk-free, right? Risk-free rate of return is 1%. Cool. But inflation's 2%. So you really you've made 1% for sure, guaranteed, but in real terms, you're actually losing money when you adjust for inflation. So if you can get that scenario, then the risk-averse bond investor now is going to have to park the money somewhere else. And if it just happens to be, let's say, New Zealand, I'll just pick one. I don't think it's that easy to buy a Kiwi bond, but anyways, let's say you get a Kiwi bond, right? If it's a 10-year New Zealand bond, I pay 4.5%. What would you rather have, right? Guaranteed to lose 1% or guaranteed to make 3 or 4%? Duh, right? So if that money now leaves Japan for that foreign bond, what happens to the value of the Japanese yen? You're trading yen now for a bond. Well, if you buy a New Zealand bond, you can't buy it with yen. So you exchange your yen for Kiwi dollar. You sell your yen, purchase Kiwi dollars. Once you have your New Zealand dollar, then you buy the New Zealand bond. Japanese yen weakens, New Zealand dollar strengthens, and it all comes from negative real interest rates in Japan. And right now, that process is being retarded by low oil prices. Boo. But if or when that process does kick in, you've yet to even see the beginning of the Japanese yen weakness. You see what I mean? The Japanese yen versus the US dollar could go to 150, but we're only at 120. It's just a matter of how long it takes to get negative real interest rates, right? And how long it stays that way. A year, 3 years? Okay? So that's what I've been watching the last 18 months. But that's what I do. That's what I do. And I'll share that information with you if you want. So I'll give you an example. I started watching this data, like I said, about 18 months ago. And about 7 months ago, Japan's largest pension fund publicly, through a press release, shared with the global community that they are proactively divesting out of Japanese government bonds. This pension fund is actually, I think, the largest in the world, if not one of the largest 5 in the world. But I think it's the largest, bigger than what PIMCO used to be, and that was what, 4 trillion US dollars or 3 trillion US dollars? Crazy, right? I think it's even bigger than that. So do you think that is important when they say they will and have already begun to divest out of Japanese government bonds? Well, what do you think they're going to buy? Some risky, crazy asset, Spanish stock market, Italian stock market? Do you think they're going to buy European bonds that pay them negative interest rates? Obviously not, because they want positive interest rates. So what are they going to buy? That's how you make money in Forex. That's all you have to do, is figure out what this Japanese pension fund is going to buy. Aussie dollars? Kiwi dollars? US dollars? British pound, right? Are they going to put it in US treasuries, or are they going to park it in a bank in London? Well, that's why now you need yield. They need to beat their inflation rates, but not at the expense of risk. You figure that out, you make money. Hey, you're welcome. Let's do British pound, and then we'll end for the day. I just want to bring this up since we were talking about it earlier. I like to watch things like IMF reports. I'd like the IMF to come out and tell the world the UK economy is improving. If I can get that, British pound's going to go up. Okay. We're currently here at a double bottom. Now, remember, I do want it to go up, but this was our short zone. So if you were here, was it Monday of last week? Do you remember? It was the swing trade. Remember, we set this up to fall approximately 500 pips. Does anyone remember? the short at 155.55. Well, we just hit 150 again. So long story short, 500 pips wrapped up with a nice bow on top. Who remembers setting up the trade clearly, logically, intelligently, step by step, with the intention of making 500 pips? Can anybody confirm that? Ron says yes. Anybody else? That's it? Remember, I said a British pound, euro, Aussie, Kiwi, and the S&P 500. Okay, Ron and Wyatt. What happened to everybody else? I dedicated an entire day to swing trading. I need to know what kind of help you want from me. How can I help? Pete missed it. If you miss a day, you need to watch the videos. How about that? The videos are posted on tradersway.com. They're also posted on youtube.com. Wow. Anybody kicking themselves that you missed it? Again, a pound dollar short, an Aussie dollar short, a Kiwi dollar short, a euro dollar short, and an S&P 500 short. We did it all in the same day using the same methodology, and every single one of them fell, which is what? Equivalent of 2,500 pips? Oh, Marina got some? Good. All right, well, okay, for people. Well, okay, the statistics aren't good. 3 or 4 people remember doing it. Wow. Yeah. All right, well, maybe everyone else is new. That's cool. Maybe we'll do this again, right? So, all right, so anyways, let's go back to a longer term chart. I would be interested now, because the issue is I didn't want it to fall. I just thought it would, based on technical analysis. That's all it is. What I would like to see fundamentally now is that. Of course, I don't think it's going to go that. It'll be like this. It takes some time to turn the ship around, right? So, but the pieces have not come together yet. So, if the IMF, tells us that they think the economy in the UK is improving, that's going to help. The MPC starts changing their tone, that's going to help. If oil prices go up, because again, their inflation that they're trying to create has been pulled back simply because of oil prices. So there's a delay in the inflation. So this whole process has been delayed. So I need to be ready. So how do you play it? You could play the double bottom, or you can play the breakout retest, right? So that's why I got to get ready. The oscillator on the daily chart, is it acceptable for a double bottom play? Yeah, it is, isn't it? So, is that a trade? No, but it gives you the signal to set up a trade. yes, this could be a double bottom. The scenario is acceptable to consider it. Okay, technically. What about a weekly chart? Well, this is what I wanted to show you earlier. We have already identified this as a key level of support on a weekly chart. Weekly, isn't that interesting? Let me try this again. Shapes, rectangle. Okay. I think this is very interesting, and one of the major reasons for this, it's simply an important psychological level. 1.5. That's it. I know it should be more complicated, but I think that's what's going on. We've had a very, very significant pullback. We're back at support, and I would like to start seeing some positive data bringing us up. Okay? And I do think on the longer term, for various reasons, wage inflation starting to hit the UK, change the tone at the Bank of England, which is fine. If oil prices ever do go up, it's immediately going to go into the CPI, which gives them the courage to stop expansionary policies and at least go neutral, which is like a taper, which would be very, very positive. The IMF could come out and say their PhDs and statisticians and economists have looked at the UK economy and give it a thumbs up. And all of a sudden, all this stuff that has not occurred yet starts to occur, and then you turn around and like, oh my gosh, we're at 165. Okay? So I was a part of this big move here that took 2 years. Well, 8 months. Okay? Pound Aussie and pound Swissy, I think were the two most traded currency pairs for me in that time period. I bought the British pound like as fast as I could, and I sold the Aussie as fast as I could, for example. Okay? So it's not there yet, but it's wise for us as speculators to be ready for that. Are we in the right spot? Yep. Are the market conditions acceptable for this scenario? Yep. So over the next 3 months, 4 months, shall we be ready for positive news out of the UK economy? Yeah, I don't know if it's going to happen, but, you know, the table's set. Let's light the candles. And maybe we can get a volunteer. Can somebody volunteer to Google the IMF website and find the date in which they will release their economic outlook for the United Kingdom? Is anyone willing to volunteer for that and give us a date tomorrow during our strategy session? You should put that down as really as homework. Like, why is that not going to benefit you? To spend time on the IMF website, going and finding reports. You might find things that you find fascinating. Maybe download the last report and see what the IMF said about the UK economy. How could that possibly hurt you as a foreign exchange expert? The reason I say this, and then I'll end today's session, the reason I say this is that you would like to be a professional currency trader, let's say, either on your own fund or trading your own money, one way or the other, right? Now, if you were a hedge fund manager, you would have a staff of economists and quants that could access the data, organize the data, analyze the data, and spit out a report of whether the UK economy or other economies are improving or not improving, right? Seems like that you would have that capability as a professional hedge fund manager managing, hundreds of millions of dollars, right? But I don't think you can afford that now as an amateur retail trader, right? How many people would like a team of quantitative analysts and economists from the best schools in the world that have PhDs on this subject? How many people here would like them to work for you for free if I can tell you how to do it? Yeah, no, I will. They work for me. I have an entire team, dozens of PhDs working for me. I just don't pay them any money. They work at the IMF. They spend months and months and months and months gathering and crunching data. Then they put it in a report and give it to me for free. So again, I hope somebody volunteers to go to the IMF website, find out what kind of reports they have available, maybe read some of them, but certainly when their next economic outlook is going to be released for the UK economy. And then maybe we could take a look at that and see if that is somehow fundamentally related to our double bottom at psychological support. International Monetary Fund. Run by Christine Lagarde. Okay. Peace on earth. May the pips be with you. May your profits be above average. If you're logged in now and you're like, how come we're just wrapping up now? You didn't adjust your clock for U.S. adjustments of clocks. Time change in the United States. It's a terrible time of year because everybody seems to want to change their clocks differently. So we get this gap between European time and American time, and we do this for a few weeks, and then it all lines up. Yeah, I know. It's frustrating as someone that works with people globally. This is a very tough time, but a few weeks goes by, and then we readjust, and everything's good again. So, anyways, peace on earth. May the pips be with you. May your profits be above average. Adjust your clock accordingly to attend tomorrow's session. And I'll see you tomorrow. Same time, same place. tradersway.com. Thank you, everybody.